everyone, welcome back to Corporate Decoder. Today we're diving into WR Berkley Corporation's latest filing, and trust me, it's more than just insurance jargon. It's a peek into how a company navigates risk, rewards its top dogs, and maybe, just maybe, asks for a few too many extra shares. Think of it this way. We're looking at the roadmap of a company steering through a world of unpredictable storms, from economic downpours to literal hurricanes, so buckle up, because we're about to decode some corporate secrets. Okay, so this is a proxy statement, which basically means the company is asking its shareholders how they want to vote on some important decisions at the annual meeting. These decisions range from who gets to sit on the board of directors to how many shares the company is allowed to issue. The company is really trying to show that what's good for the shareholders is good for them, and vice versa. They lay out how management is focused on long-term value, how their governance is all about that long-term perspective, and how their compensation programs are designed to keep everyone rowing in the same direction. Alright, let's get into some numbers. 2024 was a record year for WR Berkley. Their return on equity, a key measure of profitability, was a whopping 23.6%. This means they're making a lot of money for their shareholders. Net income per share, that is how much profit each share generated, also went up. The company's combined ratio, a measure of underwriting profitability, was at 90.3%. Anything below 100% means they're making money on their insurance policies before even considering investment income. Time for a popularity contest, the election of directors. You're being asked to vote on 4 nominees. The board is divided into 3 classes, each serving a 3-year term. One director, Mark L. Shapiro, is retiring after 51 years of service. They give a short bio for each director and nominee. You can see their age when they became a director, their occupation, and what committees they are on. Here's where things get interesting. The company wants to increase the number of authorized shares of common stock from 1,000 to 50,000 to 1,000. It's a big jump. They say it's for future financings, acquisitions, stock splits, employee benefits, and other corporate purposes. Now, for the TSPAN, non-Dinespan advisory vote on executive compensation, or what's known as say on pay. This is where you get to voice your opinion on whether you think the top executives are being paid fairly. The company emphasizes that they don't provide employment agreements or cash severance agreements. They also lay out a whole list of what they avoid, such as tax and gross up spun on perks, and dividend equivalents paid on unearned shares. A quick rundown of the executive officers who aren't also directors. It's like a yearbook for the C-suite. You can see their names, ages, and positions. Here we can read on corporate governance and board matters. The company has 8 out of 10 independent directors. It's a good sign showing that the board isn't dominated by management. Risk oversight is a big deal for insurance companies. The board gets regular updates on all sorts of risks, from financial to cybersecurity. The company has an ASPAN insider trading span policy to prevent people with confidential information from using it to make a profit. All directors, officers, and employees are aware that they shouldn't be trading using information they should not have. Alright, let's talk about money. This section breaks down how the company compensates its top executives, what objectives they have when they pay the most important employees in the company, what do they avoid when paying those employees. The company reached out to their stockholders, representing 62% of the outstanding shares, which is impressive. They emphasize that the annual cash incentive awards are performance-based, but they also use negative discretion, meaning the amount the company can lower what executives can make, but can't increase the amount to avoid short-term oriented behavior. The Compensation Committee states that they have reviewed and discussed the compensation discussion and analysis with management, and that's why this proxy exists in the first place. The Audit Committee basically says they've done their homework, reviewed the financial statements, and are recommending that they be included in the annual report. They also recommend KPMG as the independent auditor. Here we can read how much the company pays its auditors. There were over 10 million in total fees, with the vast majority going to audit fees. It is important that the number is too high in the other sections. Here's a statistic that always gets attention. The CEO's pay is 134 times that of the median employee. The CEO makes a lot, but that's how it is for large corporations in the USA. So what's my take on WR Berkley, based on this peek behind the curtain? They seem to be doing pretty well and their strategies are working. For now, the key opportunity here is to keep delivering those returns and maybe be less reliant on stock buybacks to boost per share metrics. However, you can't ignore those pledged shares held by the executive chairman. It's a situation that could create some risks. Overall, WR Berkley seems like a company that knows its industry and is trying to play the long game. But as always, do your own research, read the fine print, and don't just take my word for it. Thanks for tuning in. If you found this decoder useful, be sure to smash that like button, drop a comment below, and subscribe for more corporate deep dives.